Okay, we're going to get started today by looking at the front page of Yahoo Finance. This is a good place to go for up-to-date news in the stock market. Um, okay, what you can see from this, we have a certain amount of froth in the market right now. There's something called meme trading that's happening. Worthless stocks are going up a lot, and they're being bid up. And we have a lot of market participants buying in a good mood right now. So what else can we see from the front page? We see speculative frenzy raises the risk of market downturn, Goldman Sachs. Okay, so we do know that the S&P 500 is overvalued and it's trading at a PE that's pretty high right now. And but one thing to go against this story of Goldman Sachs, let's look at this story. Um, the power of momentum, when we look at the S&P 500, you can see it's trading above all the moving averages right now. And we have momentum in the stock market, and that's pretty hard to go against. We have two things that we keep in mind also is the Federal Reserve is in an easing state right now where they're going to be reducing interest rates. So you don't want to fight the tape, which is the stock market going up, and you don't want to fight the Fed, which is um, they're not they're easing right now. So both of those sayings are in your favor right now. Let's look what else is going on in the S&P, the Yahoo Finance. Okay, we have a good story for Google. The National Highways Transportation Safety Administration ends probe into the collisions of Waymo. It seems like Waymo is becoming the best automated car provider right now. So self-driving technology is much better than everyone else's. So that part of Google's business is picking up. And one good thing about having Waymo as a portion of Google's income is if Google has a lot of ways to make money, the chances of them being declared a monopolist goes down. And so that's good for Google. Let's look at what else is happening. Google actually had very good earnings this week, and the stock price has gone up since then. Let's look at what else we can see. Oh, okay. So we see ChatGPT is in the front page. We have, okay, AI is a big concern in the stock market right now. We have a lot of companies that are um, concerned about adopting AI. We have AI taking jobs from people. So, and we have an unpredictability of how AI can help or hurt businesses. So, and AI is almost in half of these news stories. All right, that was a good little excursion. Let's look at the S&P. Let's look at our calendar. Our calendar is we have a lot of new earnings coming out. A good portion of the S&P are reporting next week, including half of the big tech stocks, the Mag 7. We have Meta reporting on Wednesday. Let's look at some of the big reporting companies. Microsoft, Meta reporting on Wednesday. Those are the big ones. We have Apple, Amazon on Thursday. We're also following Waste Management on Monday, Procter and Gamble on Tuesday, and Visa. So what we're going to find out through Waste Management is kind of the health of the economy a little bit. We'll see how Procter and Gamble deals with the tariffs. We have Visa that'll tell us a good idea of how the consumer is spending. And then we have the big tech stock reporting. We already we had last week Google report earnings, and they said they had really good advertising revenue. So there's a very good chance that Meta will have a good earnings report also because they're in the same industry. Microsoft is one thing we're also waiting for is how they're spending um, in the AI world. They're probably going to say we're spending a lot of money and increasing their spending, and that's really good for stocks, the chip makers like NVIDIA. We have Apple coming out on Thursday, um, and they're going to hopefully give an update on how their China sales are doing and any AI initiatives that this is a good time to say that. And Amazon also has some tailwinds. They have an advertising part of their business, so that's going to help them. They have um, AWS, which is growing, and of course they have their Prime Day that they can report about. Um, so all in all, this is a pretty big week. So let's look at so we're right now we're super overbought in the stock market. If we look at if we look at our stochastics, we've been overbought for multiple months. And this is a it, whenever we're looking at overbought versus oversold, um, we always like to buy stocks whenever they're oversold and undervalued. But right now, the market is basically keeping this momentum going, and it's not necessarily a sell sign whenever you're constantly overbought, but it's just a sign of caution. So, all right, so we're actually let's look at some more things here. Okay, we're going into one of the worst months of the year, seasonality wise, August and September. So just be ready for a pullback if we ever get one. And we're going to have heightened volatility in the months of August and September. So be ready for that. And let's look at our numbers for this week. S&P is up 1.3% this week. 62% of stocks are above the 200-day moving average. That means we are continuing to have momentum in the market. And that is a powerful thing whenever there's a fear of missing out. There's a lot of people that missed the stock market rally from the bottoms. And we have some help from the US Treasuries. The Treasury 10-year yield is down 0.5%. So that's an inverse correlation we have. Let's look at our chart here. Okay, so you can see the yield of the 10-year going down, and there's an inverse correlation that the S&P is going up. And the simple reason for that is that if the borrowing rates are lower, companies end up being more profitable because they don't have to pay as much for borrowing money. And okay, so let's look at some more numbers here. Our okay, there are 62% of stocks in the S&P above the 200-day moving average, 67% above the 50-day moving average. All right, so there's some tariff resolutions this week. So this is the more tariff deals that are made, um, that gives the market more certainty of how to deal with the trade environment. So you can see from our calendar, we have we have an August 1st deadline. Okay, that's going to be when all of these trade deals are due. We don't know if that's going to be pushed out into another date, but if we get some more resolutions for tariffs, such as the European Union, that's going to really help the stock market go up. All right, so let's look at, that's the big picture. Let's look at, okay, let's look at the major variables in the stock market. The price of oil is down just a little bit from last week. It's still very relatively low. Below 65 is a really low oil price. That's meaning that translates to, the economies around the world um, are slowing down in general. And let me see, inflation hasn't changed a whole lot since last week, down a fractional amount. So there are tariff pressures, but tariffs don't seem to be affecting inflation at this time. Um, you see, and the US dollar index is up a little bit from last week, but it's in a downtrend so far this year. Um, because the dollar is down, look at this chart from this beginning of this year to we're down at least 7%. And that's going to help all the multinational companies and their earnings for like Google, Facebook, Meta, I mean, they're going to be like 3% better for the part of their portfolio they make overseas. So let's see what else is happening here. Okay. So the fear and greed index, we went from extreme greed. No, we went from, yeah, we're in greed right now. So greed, the translation is you just got to be cautious. Can't get overextended when everyone else is buying. Um, but we've been in this extreme greed um, as the stock market keeps going up. And we also have the amateur investors bullish. That's a contrary indicator also. So we have Goldman Sachs saying speculative frenzy raises risk of stock market downturn. So it's an unpopular um, thing to bring up when all the stocks are going up. But um, one bad story could make the stock market go down. And you got to be ready for that. All right, so let's look at let's look at the VIX. The VIX is at 15 now. That's a sign that there's no fear in the market. We have a lot of complacency. So let's see if this picks up towards the next couple months. Um, our emotional graph. Okay, so it seems like we're in a new paradigm mode. People are concerned about that. They're not concerned about tariffs right now. They're more concerned about the fear of missing out. So we are in the new paradigm, delusional and denial phase, kind of right around here, and we're in greed. So you got to be realize, that in general, and be prepared for any announcement or something that happens that could cause the stock market to go down. All right, so things that could lead to a crash. What exists that could lead to a crash? We still have tariff threats, any geopolitical threats. Um, what other things could happen? We have if a Magnificent Seven, if any of those next week report super bad quarters or give a warning about AI demand, that could cause a stock market to correct 5–10%. What other things can happen? Random Trump actions or words. We don't know what that could be. So those are the biggest concerns, the biggest being tariffs right now. So it seems like those are being resolved one at a time. So it should be, um, um, so we shouldn't have that issue if we get some more resolutions before that deadline. All right, so PE ratio in the S&P is still elevated around 24 to 25. And that means we're overvalued. So we could easily correct 20% in the stock market and go down to fair value. So right now we don't have that. I don't see that happening with the momentum in the stock market. All right. So let's look at the first that are worst. From last year, we had communication services, IT, and consumer discretionary up the most. And this year, the ones performing the best are industrials, IT, and XLU utilities. And then financials are just behind them in communication services. All right, so let's look at the worst performing is the consumer discretionary and healthcare. Healthcare again is in the worst category, but it's actually starting to get a bid. We had um, this week we had this small rotation from some of the best performing stocks to some of the worst performing stocks. It was very slight, but it helped the healthcare index go from -5 in the year down to -1. So let's look and see if this healthcare ever has some momentum. I'll go over, hmm, this is a good chart to look at. Consensus forward 12-month PE valuation. Okay, so this gives an idea of how extended the IT sector is. It's 95 percentile. And the most undervalued sectors, energy, healthcare, financials. So this is a really good chart. We'll go back and check on it on a regular basis. So right now, people are really bidding up the IT sector, the consumer discretionary sector, industrial sector, because compared to the 10-year, 30-year averages, um, they're trading above what they normally trade for. And opposite side is the energy sector. People are not paying nearly what they paid in the past for that sector, and the healthcare and financials. So financials seem like they have a good way to run because they have a lot of tailwinds this year. But healthcare doesn't seem to get a bid. I'm not sure why. All right. Well, one of the biggest problems with healthcare right now is there are threats of um, imposing tariffs on pharmaceuticals made overseas and imported. So we'll see what happens there. NASDAQ composite. Okay, this is there are people all over the internet trying to match up a pattern from a past year to the current time. And I thought this is pretty interesting. There's a and this correlation starts in 1995 versus um, 2022 to present. So this blue line is the 1995 and 1,000 days after, and this line is 2022 to present. So this is our current bull market in yellow compared to the old version. And it's interesting that it's kind of matching up. And we had a little bit more, if we were from matching um, performance from 1995 bull market to this bull market, we can see that there's like a little 10% correction here, and then there's a huge correction. If there's like this happened to be a hedge fund that blew up, in that time that made the stock market really crash. But you got to be ready for these times whenever you have a 10% correction, if there's like an Asian financial crisis or something. So right now we're actually, you know, um, tracking this pretty good. So we'll see if well, I'll check back on this like every couple months to see if we keep tracking on to this same chart. All right, let's look at some of the stocks going up and down today. All right, so let's look at the sectors. First of all, let's look at the 10-year to see if we're going up and down. Okay, we've been going down recently. See, this past week we're going down. So we expect, let's look at our cheat sheet. Yields of the 10-year going down. That's good for small caps, any stocks that are heavily indebted, high yielding stocks, because it's going to be harder to get a good yield. Home builders, speculatives, and REITs. All right, so let's look if that's what's happening. Okay. So the material sector, consumer discretionary, industrial, financial sectors are doing the best. The ones doing the worst, gold miners, telecom, regional banking, oil, real estate. So that's opposite of what we would think, because if the yields are going down, that would help real estate. Um, that would help the telecom sectors with high dividends, and you see, that would help the banks. Let's look at what's going up the most. Material sector, consumer discretionary, industrial select, and gold miners, financials, home builders. Okay, so that makes sense. The home builders would be helped because interest rates go down. That's really good for home builders. Healthcare, they're high dividend paying stocks, so that would be a benefit from lower interest rates. And biotech, okay, I guess they'd be helped by lower interest rates too because they're borrowing money. All right, that was good exercise. Let's look at the market movers for today. Deckers is the highest performing stock today. They sell Uggs, and they had a really good earnings report saying that the Uggs are very popular. Newmont Mining, um, they just had earnings, and they said the price of gold has really helped their company. And that was on our stock screener list last week and a week before. And a lot of healthcare companies in this top 10. We have Centene, we have Edwards Life Sciences, um, Molina Healthcare. Okay, so perhaps the healthcare could be getting into favor now. Well, we don't know. Let's look at the top decliners. Intel, Charter, let me see, Vistra Energy. Okay, a lot of these are I don't see a real pattern here. A lot of these are all stocks that are recently reporting earnings. Um, this is interesting. Charter Communications down 18%. That is pretty big news because this is a very conservative company. It's a utility. They sell, let's look at that one. Let's see why Charter is down so much. This is a really big company for it to go down 18%. Wow. Let's look at let's look at what's the news here. Let's look at the news. This is an example of a stock that we looked at like a year ago and it was kind of overvalued and wasn't really that interesting. But if it goes down 18%, that's a good, okay, let's see. Year-to-date return, -9%. 1-year return, -1%. So they haven't returned anything in the year. Okay, let's look at their PEG ratio is 0.4. According to that, our quick math is it's half undervalued, based on yesterday's numbers. And let me see. The return on equity is excellent at 33. So their business is a combination of media. They have I think they have several media companies, and they sell internet access. So that is pretty amazing that they're down so much. And it seems like they're half off. Let's look at their estimates. Each chart. Oh, this is charter communication. Okay, this is a different stock that I thought. I thought it was Comcast. Okay, but this is Charter. This is a different. Let's look at the profile. This is a new company for me, so we're gonna look at the profile to see what company it is. Charter Communications is a broadband connectivity and cable operator serving residential. Okay, so it's close. Why are they going down so much? Let's see. Announced quarterly EPS missing expectations. Okay, they missed their numbers by 5%, so that's why they're down. It was an earnings miss. So it seems like they have all the numbers that we're interested in. And let's look at their debt level though. Cash is 1 billion, total debt is 9. Oh, that's the problem right there. They have 95 billion in debt and their market cap is 51 billion. So they must have acquired companies to get to where they are now. And they're sinking in debt. And that debt is the biggest problem with this company. So if they missed by just a little bit, there might have been a sell-off. So yeah, so this is I wouldn't touch this one because it's dealing with a lot of they have to pay off a lot of debt before they're really going to be profitable. Okay, so we'll come back to this another day. Okay, so that was a good exercise to go over those. Let's look at Dan Now's picks from the beginning of the year. Cisco is up 16%. That's pretty good. And ADTN up 10%. The banking ETF, 15%. That's becoming the best, one of the best picks now. And we have deregulation for the banks, and the banks are coming out with their good earnings too. Um, and interest rates are going down. That helps the banks. So let's look at some of the charts I picked out are interesting. We saw last week Meta was totally oversold, and it was kind of right here. They're coming out with earnings next Wednesday. We got a hint from Google that advertising is very hot right now, and they're probably going to get good advertising earnings. So we'll watch that, and we'll see if Meta stays within this boundaries um, for the next time they report their earnings. The next one is Walmart. Look at this; it's out of favor right now. This is an example of a stock it's a slow and steady stock. They pay a dividend of like 3%, and whenever we go into some of the um, nasty times of the summer, like we're going into two of the worst months of the year, people will be reaching for a conservative stock like Walmart and a dividend. All right, so let's look at um, some more things I found. B of A's Hart renews warnings of bubble risks for stocks. Okay, so this kind of echoes what we saw on the front page with Goldman Sachs was saying it's getting frothy. Here's here's the article. Now it says the next 7 to 15% is down in the S&P. At nearly 25 times earnings, prices have over discounted continued growth on trade news and earnings time of the year when stocks tend to weaken. So Bank of America also subscribes to the seasonality that we've been talking about for ages. This seasonality right here, where August, September are some of the worst months of the year. So we have a froth going on. We knew that July would be a decent month. We didn't know, but it's usually a better month. And Bank of America is basically saying, you know, that some of the stocks that have ran up the most, that are speculative, are going to be the ones that are the most dangerous to be holding. So let's go back to that story. And I'm not saying that you sell out of stocks and if you see the summer coming, it's just you have to like make sure that you prepare yourself mentally whenever you think the stock market could be going down and not get overextended. And okay, that's it. Let's look at our stock screen for this week. Look at this. JP Morgan is at the top of our stock screen. Um, that's one of my longest holding positions. And GE Veranova was in the first time is in the top 20. GE Veranova is a stock that Kramer likes a lot. And we'll talk about that in detail like right now. But here's another story from Jim Cramer. Here's six stocks he says to buy here right now. One is Capital One. We talked about that last week. Disney, Goldman Sachs, DuPont, Honeywell, and GE Veranova. Why would he like each one of these? Capital One, we talked about it last week, I think. They're like undervalued by 20%, and they are only a $100 billion company, whereas a lot of the big companies like Visa and MasterCard are 7 or 8 times bigger than that, and they have a lot of room to grow. They just bought Discover Card and Discover, and they're integrating that into their company now. So that's why he's excited about that. And Disney, um, he likes that because it's a long-term hold. Um, they have a lot of business in their parks part of their business, and they can basically charge whatever they want. And and they're building their direct-to-consumer streaming business. And it's not all that profitable yet, but they're getting there. It's a little bit too expensive for me. Goldman Sachs, they're benefiting from increased IPO activity and deal making and trading. They have a lot of business in trading. DuPont, um, I'm not sure why he likes that. We'll skip that. Honeywell. Honeywell is actually, they reported their earnings this week and they're starting to go down. Honeywell is going to break up next year, at the end of next year. So that could be one to watch if it gets really undervalued. Um, we know whenever GE broke up, the sum of the parts, it almost like 2 or 3 times than what it originally was selling for. So GE Veranova is a stock that's one of those stocks that GE spun off in the breakup. And this is one Jim Cramer likes a lot. So Jim Cramer says his best choice of all these stocks is GE Veranova. Vernova. He said there's a long-term cycle natural gas buying to fuel the growth of our electrical grid. He says 5% growth to the nation's grid, and they will use the turbines of GE Vernova for that. And they just reported earnings this week, and they went up like 13%. So they're a little bit overextended right now. But other countries can be buying these turbines too whenever they ramp up their energy usage. So we have to watch all the stocks that the president is bringing to these countries. I think GE Vernova was one of the companies. So Cisco was another one. So um, let's look at the numbers and the chart for GE Vernova. You can see that it's in an uptrend. This is one of the best stocks this year, actually. And it's a little bit overextended. You can see it broke out of this uptrend and maybe into a second uptrend here. Um, but it's like it's kind of gone parabolic and it's been overbought for several months. So it looks like it has some momentum right now. Let's look at the numbers. It's supposed to grow from this year to next year 63%. So growing at 63%, the PE ratio is 89. That's pretty high. So the PEG ratio is 1.4. Our simple calculations, you divide the PE ratio by the growth, and that gives you the PEG ratio. So it's around 40% overvalued. Um, so the pros are it has an AI infrastructure build out um, theme, and a demand for energy in the US is really, really big. They had a great earnings report this week, so that gives us some momentum, and the gas turbines they sell will be in demand. And one con is they're pricey, they're overvalued, um, and that's all the cons I can think of right now. Let's look at the numbers for GE Vernova. Market cap 169 billion. The forward PE is 89. That is pretty high. And the PEG ratio, according to Yahoo Finance, is 3.79. So that means Yahoo Finance thinks that they're not growing. They're growing like 20% a year. Let's look at their um, the financials. The profit margin is 3. That is 1/3 of what we're looking for. So that's not so great. Return on equity is 11. That is on our bottom edge of what we're looking for. Total cash, they have 6 billion in cash. That's great. And they pay a very small dividend, which is less than 1%. Okay, let's look at what Morningstar says. Morningstar says they're about 56% overvalued as of when they make this report, which is in January. So they must think it's much more overvalued now. I don't know. So that's an older report. Um, let's look at the CFRA. They updated their report most recently. They said that to hold, so it's not a buy right now. That means it's fairly valued according to them. Our hold opinion reflects our view that GEV, their premium valuation reflects optimistic assumptions, which could increase near-term downside risks on a weaker economy, poor backlog execution, or negative shift in AI data center growth. We think shares are worth holding for longer-term investors as we think the underlying growth story remains compelling. Okay, so let's look at what they think the fair value is. They say it's overvalued by 13%. That's close to what we were saying. So we know it's overvalued, um, but it does have momentum. Let's look at another stock that Jim Cramer likes. He likes this Cisco. It's been one he's watched for a long time, and he says the reason to buy like Cisco, they're an old router company. They used to make routers and in devices for the internet when it first started building out. But now they have subscription revenue. They bought Splunk, and that helped them with their subscription revenue part of their business. So that makes up 50% of revenue, and that's more reliable than selling hardware. So that will help their gross margins. And um, so let me see, increasing their gross margins have increased from 64 to 64% to 68% this year. So let's look at their valuations. It seems like they had negative growth last year, but this year they're scheduled to grow 8.1% from this year to next year, and then 11.4 after that. So I averaged that out to growing at 9%. With a 2.4% dividend, that's like 11.4 total return. So the PE ratio is 17. That is about 20% lower than the average stock in the stock market. And it's if you divide 17 by 11, that gives you a PEG ratio of 1.4. That's 40% overvalued. So let's look at their numbers. They're $270 billion company. The forward PE is 17, and according to Yahoo Finance, they're 2 times overvalued. And their profit margin is really good at 17. That's a little bit more than we're looking for. And return on equity is double what we're looking for. So they're a very profitable company. And they have around 16 billion in debt right now. That's one thing to watch, but it's very small compared to their market cap. And they pay a 2.4% dividend. So this is a not compelling stock to me. Seems like it's a little bit overvalued. So I wouldn't be interested in this right now. If we look at their stock chart, you can see it's definitely in an uptrend, and it's approaching overvalued right now. So it's halfway between its channel lines. So this is an example of a stock that I would wait until it goes back down to here when it's oversold to start buying that one. Let's look at what CFRA said. They said it's a hold. They're not that excited about it. They said that the short-term headwinds are more intense than we expected, and that Cisco has now become a show me story. Long term, we have a positive outlook on the trends, but cannot become more positive until they materialize. We see Cisco benefiting from a rapid rise in bandwidth consumption, the high demand for data center solutions, and the migration to cloud networking. Okay, and they have share buybacks too. So they think it's overvalued by 14%. So that's kind of close to what we were saying. And the free cash flow seems to be all over the place. It doesn't seem like to be in a straight line. So all in all, this is an example of stock that I would wait for it to go down before I would buy it. And the fair value, according to Morningstar, is 20% overvalued. So shares reflect aggressive AI expectations. Cisco was one of these companies that went with President Trump overseas to Saudi Arabia, and they're going to benefit from a lot of the AI expansion um, the president is implementing currently. Okay, so here's another story that came out. United Health says it's under federal investigation for civil fraud. Okay, so we've been saying for a couple weeks now, managed care sector seems uninvestable. Whenever you have whenever you have so many companies coming out with bad earnings and you have civil fraud, about a company, this United Health is an example of a stock that we've been following in the top 10 in the mutual funds for a while now. But whenever you have news stories like this come out, like seemingly every week or two, um, it makes them uninvestable because almost every stock in this industry, the managed care sector, seems to be having problems. So I'm like staying away from these companies right now. Um, okay, so that is all I had to say for today. I hope you liked that talk, and I hope you have a good week of investing, and I'll see you next time.